We are going to discuss the question number 9 in BRG, the consolidation dividend adjustment, right? The following statement of financial position were taken of the books of X Limited and Q Limited was 31st December 2022. In the sense, this is the reporting date. There are additional information given. The statement of financial position is required, consolidated, right? X Limited acquired 75% of the equity. Sorry, before moving to that, we will fill up the opening balances. The equity 3,750, 1,800. Right, retained earnings 900, 7,000. Sorry, 750. Retained earnings of the subsidiary 750, 900. Right, it's okay. It's clear, right? It's I think it's clear. It's clear. Next, general reserve 1,200, 450, right? 1,200. Yes, that 450, right? It's also clear. After that, we can move to another adjustments, right? Right. Uh, X Limited acquired 75% of the equity shares of first January 2021. It is the date of acquisition, right? Right. This is the date of acquisition. We have 2 years post-acquisition period 2021, 2022, right? The retained earnings at the acquisition date is 600. We want to translate to cost of control account. Retained earnings 600, right? Cost of control credit. The subsidiary retained earnings debit. The subsidiary retained earnings should be debited. Here, the debit. And the cost of control account credit, right? Here you can see that the retained earning of the subsidiary, right? B. Second adjustment, the general reserve is 300. General reserve, subsidiary general reserve 300. That's cost of control account, right? The fair value of net asset all net asset on acquisition date is 3,300. Now it's given 3,300 all net asset, right? We know that retained earnings is 600 as per the question. General reserve also we know that. Traded capital assuming not changing the subsidiary 1,800. Altogether we have ended up with 2,700. The remaining balance is the difference between this and this is what? The remaining fair value excess. We have a 600 worth of fair value excess, right? Fair value excess. How I derive that? The question says that the fair value of net asset total is 3,300 at the acquisition date. So we know that return earnings given, general reserve also given, and stated capital. No any part in equity. All three are given. The remaining is fair value excess. In question number 3 also said that the adjustment number 3, any fair value amount excess in the book value should be attributable to inventories 1000, sorry, 120. මේ 600න් 120ක් යනවලු inventories. The inventories, the remaining goes to where? Remaining goes to minus this, goes to where it is given. The remaining is plant and machinery depreciation over 5 years, right? PP, let's assume PP. The double entry should be past inventories. Firstly, we want to recognize the inventories 120, and the inventory should be debited by 120, right? All right, plus 120. like that, right? The second one is what 480 of the plant. 480 left here. We can see that 480 worth of plant is there. The double entries. PPE should be debited. 480. The credit where the cost of control account should be credited, right? Plant 480. There's no any land, so no point of this queuing here. Right. Now you want to depreciate because the inventories are not depreciate. It is a current asset, but plant are depreciate over 5 years. So 480, if it is has 480 over 5 years, but we have 2 years time after date of acquisition. So you want to multiply by 192. So the double entry is the plant credit, the subsidiary retained earnings should be debited. 192 excess depreciation, right? Depreciation. Am I correct? 192. Is it okay? 192, right? Now you want to deduct here 192, right? It also done. The above fair value in net asset are not included. 450 worth of intangible asset. Intangible assets also we want to recognize. Intangible asset 450. In here, you assume no amortization because the question not mentioning. If it is so, if mentioning, we want to amortize it over useful life for the 2 years time period, right? 450, that the credit should be gas to cost of control account, intangible 450, intangible asset 450, right? Also done. And the contingent liability 150, contingent liability, what is it? Is a liability and debited to, yeah, 150. Cost of control account, it reduces the net asset at the acquisition date. That is why, right? The contingent liability 150. It's given, right? Right. So we want to, since the inventories are current asset, it is selling out to the 1 year time period, less than 1 year period. So since the acquisition date is 1st January 2021, the reporting date is 31st December 2022. We have a 2 years post acquisition. We assume that it is sell to the outsider. So now it's realized, right? The fair value is realized. So you want to eliminate that 120 from these two things. The inventory should be credited because it is outside sale. 120, we want to derecognize the excess overstated profit in subsidiary. Subsidiary return earnings should be debited, right? 120. Where is that? There, 120 fair value inventory. FV inventory, right? It's also done, right? Now it's over. The dividend adjustments, it is the good adjustment, right? Give me 1 minute. Okay, the dividend adjustment, dividends proposed. This is the third scenario because the subsidiary declared the dividend, but the parent not recognized or recorded in the dividend. In that kind of a scenario, you want to firstly recognize the dividend in parent books, and it after onwards counter cancel the intercompany balances, right? In here, it's mentioned that the dividend proposed 415 parent and subsidiary 450. Let's assume 415 subsidiary. But entire portion it's not belong. අපිට ඔක්කොම අයිති නැහැනේ. Dividend තියෙනවා මේකේ 450. But out of that 75% only belongs to us because we are the parent only own 75% acquired. The control is up to 75%. The remaining goes to NCI. NCI is outside, right? So we want to eliminate these things. We want to firstly recognize in the parent book. What's that? Huh? Dividend since not yet received in monetary terms, dividend receivable in parent's account, receivable debit this much, right? Dividend receivable debit this much, right? Well, debit. Credit to where? Group return earning, consolidated return earning, group return earning, credit, not debit. Credit this amount. Firstly, you want to recognize the dividend receivable debit, right? Dividend receivable debit. For the clarity purpose, I'm writing there is no point of recognizing such, right? Insert dividend receivable debit. Due receivable. How much? No, I am here writing here, right? Literally, Anna. What is the balance? 3375. Right. The group retained earnings should be debited. Sorry, credited, right? The consolidated retained earnings should be credited. Where is the consolidated retained earnings? In here, right? 3375 due receivable. Now we want to counter cancel interbalances. Dividend. So in parents' perspective, it's a dividend receivable. Subsidiary perspective, it's a dividend payable. So you want to counter cancel means the reversal of that entry. Dividend payable debit, dividend receivable credit. So now the dividend receivable should be credited. Ultimately, there's no any impact. That's why I'm telling you the putting such adjustment is not required for the dividend receivable, but dividend payable should be reduced to the credit. It should be credited, right? I mean, dividend payable to derecognize this right. Those are the adjustments in here, but now we have that NCI adjustments. Sorry, purchase consideration is 400, 2000, 400, not 4200, right? 4200, 4200, where the purchase consideration 4200. Right now we want to recognize there is no need of investment, right? NCI portion. NCI is not given. The proportionate method is applicable. In that case, the acquisition date net asset into percentage of NCI. The total net asset is this much. Own shares, inventory, plant, subsidiary, return, and intangible asset, general reserve. Here we can get the auto sum here, right? Into 3750 net asset. The fair value of net asset at DOA is 3000 this much. But we only NCI belongs to what? 25%, because 25% only NCI. In that case, what is the value? The NCI value is this 937.5. 937.5. Credit should be NCI account, right? Right. It's also done. Done and dusted, right? 937.5. 930. Then now it's over, right? Now in the balances, the PPE 6,300. Haida tundas tunsi tundai, right? Tundas tunsi. We want to recognize the goodwill. Goodwill recognition, such goodwill recognized. Goodwill. Oh, we have a gain on bargain. No, goodwill, right? Right. The remaining balance goes to this. No, I will write here. Goodwill. Minus. Alright, goodwill. Here, this want to link goodwill. Yeah, we want to copy paste it. Oh my god, what's happened? Goodwill. This is the goodwill amount. This, right? Goodwill amount, right? So now we want to close the subsidiary return earnings. Subsidiary return earnings. Oh my god. I'm erroneously putting the subsidiary account in India. Oh my god. Sorry. In here, need to recognize, right? Excess depreciation. Not in subsidiary general reserve. Sorry, right? Fair value of inventory. So sorry. Now do you want to transfer because I think we have a negative uh, profit, right? It means loss. To put here the oh my god, hurry. We have a total this much, but opening balance is this much. We have a post acquisition loss. Loss is 162 divided by group. Group return is 75% in here. 75 in the sense 162 into 75%. The remaining goes to NCI. NCI shareholders, non-controlled holders is 25%, 40 by 50. 40.5 NCI. Yeah, is the NCI out? No. 40.5 NCI. 40.5. The group retained earnings should be how much? Group consolidated retained earnings should be debited 121.5. 121.5. Group retained earning 121.5. What is it? Sub retained earnings. Sorry. Retained earnings. It also now you want to recognize the subsidiary general reserve. Subsidiary general reserve 150. 150. 150 because 450 තුන්සියක් ගියොත් 150 තුරු එකෙන් 175ක් අපිට යන consolidated general reserve right con gr this is the general reserve नु 112.5යි sub gr right remaining goes to NCI right remaining percent I means 25 NCI NCI should be credited 37.5 37.5 right now it's over now we want to I mean close down these areas the subsidiary general reserve we have this amount right one type portion we can recognize there is a known distribution subsidiary reserve balance 131.12.5 131.12.5 131.12.5 subsidiary general reserve sorry general reserve consolidated hari ini 131.12.5 now general reserve මේකත් හරි subsidiary general reserve hari subsidiary retained earnings hari consolidated retained earnings balance carried down is this is the PCD 116යි right done right no such impact right now all are done and dusted we have investment okay inventories 1,50,810යි 1,50,810යි 1,860යි right 1,860යි මම මෙතන එකපාර දාන්න 1,860යි trade receivables we have yes 480යි 390යි 870යි right we have this much prepayments we do not have in previous session we have that's why that excel එකයි මම ගත්ත 630යි cash 630යි total we have how much worth of assets not that also මේක අපි ගන්න. නේ බෑ කාර්ඩ් පොඩ්ඩක් ඉන්න just. What wait නේ. PPE balance need to be recognized, right? PPE in statement of financial 6 out 6300යි right 6300යි 6 එතකොට අපිට එනවා 6300 plus 480යි minus 192යි 6588යි 6588යි right. Now the total asset we can recognize directly 11936යි right. NCI balance අපි NCI balance කරේ නැහැ. What is the NCI balance? Cost of control. Okay, here we want to recognize the NCI portion, right? NCI is 934.5 934.5 right. So we have equity okay, NCI also okay, 10% debentures 2400යි 2400 once I will recognize the no bank loans any bank loans. Contingent liability also we recognize. The trade payables, do we have a trade payable? Yes, trade payable we have 1080යි 570 510 1080යි 1080යි. Dividend dividend we have adjustment right. Dividend 900යිනේ 450 450 900යිනේ 900න් අර ගන්න අඩු වෙන්න ඕනේ right 400 480 900යි 900න් 337.5ක් අඩු වෙන්න ඕනේ 337.5යි. හරි accrued expenses 450 180යි 450 180 630යි done and dusted. දැන් බලමු balance වෙයිද දන්නේ නැහැ. 630යි. Do we have any adjustment? Accrued expenses, no any adjustment. Okay, God bless you. I think now it's not balancing නේ. balance වෙනවද? කරාට දෙයක් නැහැ ළමයි. Yes, it's balancing, right? This is the answer. Hope it's clear to you. Thank you. Have a nice day.